Okay, Orderflows presents the price rejector, how to determine when the market is rejecting price and how to profit from it. My name is Michael Valtos. I'm the founder and trader at Orderflows.com. First, a brief disclaimer. This presentation is for educational and informational purposes only and should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that can be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Okay, so what is the price rejector? It's an indicator based on order flow analysis to determine when the last buyer has bought and when the last seller has sold. When the last buyer has bought, who's going to support the market? Nobody. The market is going to naturally move lower. When the last seller has sold on a move down, where's the resistance? There's no resistance. The market will start to trade higher. That's just the nature of the market. The price rejector, it runs on the NinjaTrader software platform. It's easy to use. You just import it into NinjaTrader and start trading. It's designed for an order flow footprint chart, but now it's been programmed to work on a normal bar chart. One of the additional features that we put in is you can link a sound file to it. So say you're watching a bunch of different markets and you only want to, it's maybe hard for you to concentrate, staring at a couple screens, 4 or 5 screens. Nowadays people have up to 6 or 8 screens, and they're looking at all different time frames. You can link up a sound file so it'll go off. There's no PhD needed. You don't need to be a rocket scientist. There is science involved, but it's not rocket science. You don't need a live trading room. You don't need to be listening to somebody say, "Hey, buy, I'm long, I'm short." Forget that garbage. I do have a trading room though, by the way, and people that are in it, know that sometimes I take no trades on certain days, and sometimes I only take 1 trade. Usually I try to take anywhere between 1 and 4. No emotion needed. Well, actually, I should change that from no emotion needed to not much thinking needed. There's always going to be emotion when there's money involved. I don't care if people get emotional unless they're super rich and losing a couple hundred here or there. This isn't going to have much effect on them. But honestly, for anybody to say there's no emotion in their trading, I think is wrong. Maybe unless they're stone cold killers or something, that they have no emotions. But really, I should change that to not much thinking needed. We design our indicators to replicate what we're seeing in the market with the order flow, so that we can concentrate on multiple markets and different time frames at the same time, rather than having to be watching what's happening in one market in one time frame. So have you ever wondered why prices stop and reverse at levels in the market? Reversals happen several times a day. You have the high of the day, you have the low of the day. You get various swing highs and lows throughout the day. So there's plenty of trading opportunities. If you're sitting at home thinking, you're drawing your trend line, or I say trend lines, you're coming up with your levels for the market. And you think you found the secret way to draw levels in the market. Well, that's all well and good. You could probably draw random lines on a chart and the market will react to them. Personally, I'd rather have market generated information. Let the market tell me that, hey, volume is drying up here, buyers are drying up, sellers are drying up, rather than just trying to take a stab. Because if you're just trying to figure out your own levels on your own, you really need other people there to support those levels. If you're going to be, you're choosing a level, say, 2103 in the S&Ps. Okay, well, if you're the only one in the world that thinks the market's going to reverse there, well, unless you're the world's biggest trader, it's probably not going to reverse there. Yeah, people say, well, it's the GAN line or something like that. Well, yeah. There's a lot you can come up with. You could justify anything in the market these days. Personally, I'd rather have pure market generated information to tell me what is going on in the market. So markets move up as people buy and buy. However, as you near the end of a move, the buying starts decreasing, and eventually the last buyer or buyers has bought. There's no more interest in buying, and as a result, there's no more support in the market, which causes the market to turn and go lower as the higher prices have been rejected. So again, the market's going up, up, up. Everyone's buying. Well, then everyone says, hey, why are we still buying? Prices are quite high. People stop buying, and then naturally the markets will start to move lower. So here's an example. This is a mini 1 minute chart. Going up, 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 up. Everyone's buying. Hey, we're going up to the highs. Boom, boom, boom. Okay, hey, what are we doing up here? And you start to come off. You sell off. This was a nice move from the 58 level down to around the 53 level down here. And you get another signal and another signal here. So, really, if you're going to be trying to pick reversals, again, I'm not trying to pick the exact highs or exact lows. There's going to be times when you have a high and there's no signal, and you have a low, there's no signal. It's got to meet certain requirements in the order flow. You'll get signals throughout the day. If you're not getting signals throughout the day, then you probably don't have it loaded properly. But you're looking for the areas where you have a move, people are buying it on the way up, and then people reassess, and then the buying slows down and eventually stops. And then what happens? There's no more support in the market. As before, you had the buyers. Where's your buyers now? You see them dry up, and now you see mostly red candles on the way down. Before you saw predominantly green candles. And conversely, markets move down as traders sell and sell and sell some more. As the market reaches the end of a move, the selling decreases, and eventually the last seller has sold. There's no more interest in selling, and as a result, prices move back up. The lower prices have been rejected. It's the opposite of what happens on an up move. You're going down, down, down. Okay, here, boom, you get a big sell here. Big push lower. This is a 1 minute chart. Another big push lower. Okay, you got a signal here. Hey, maybe this is the low. Okay, we did reach it. I'll be honest. Sometimes it takes the market a little bit to find its low or to find its high. Now, are you willing to risk? You're talking 20, 30. What is that? About 20, 33. Risking basically a point and a half. To get a move like this, it's not always going to be able to pick the exact low. Ideally, ideally what you love is just to have this signal here and not this signal. But honestly, sometimes it takes the market a little bit of time to find this exact low. That's why you should learn how to use stops. If you're not using stops, you should learn how to manage your risk. Again, would you rather have this a tight stop here to risk a point and a half max for a chance to make this? This is 32 up to we'll call it 42. Just be very conservative. After this big push, you may be thinking, hey, I could get out here. I'm not saying you got to get out up here at 47. Definitely not. You can at least get 10 points out of it. You have to ask yourself, are you willing to accept a small loss like this while the market is looking for its low and catch a big move like this? I would I would do that every day, all day long. I'd rather risk this small, a small point and a half to catch a big move like this. Just, earlier you caught a nice move here. You're getting short. This is what, 39-ish, down into, 34. So you already had some, something booked, at least a little bit of a profit to give you a little bit of a breathing room that you could try and take a trade here. You get stopped out. Okay, you get stopped out. I mean, that's trading. Not everything works 100%. Honestly, if you think every trade that is generated by this price rejector is going to be a winner, don't watch anymore, because there are going to be times when, there are failures. You do get stopped out. Nothing is 100%, although some people like to think everything is 100%. You watch some videos, they only show you the winning trades. They don't show you the losing trades, but, I'm trying to show you that, sometimes the market struggles to find its low level. In this case, you get doji, which is often a sign of, in Japanese candlesticks, it's a reversal sign, yeah, but it's also a sign of indecision. you see the volumes kind of drying up down here. These bars are not as wide as you saw earlier. The market is setting up. It's setting up for a nice move. Okay, yeah, you took a small loss there. It's not the end of the world. It's 7:45 in the morning, Chicago time. You got all day to trade, especially if you're, trading a little bit earlier. You had already a nice move. Some people will be happy just to catch a move like this move once a day. Turn off the computer. Hey, I'm done. But you do that. Oftentimes you'll miss. You miss something like that. There's going to be days where you have 3 or 4 signals. They're all losers. I'll be honest with you. But it's all about managing your risk. Then you come up here, you get another signal, and the market starts to come off a bit. So how does the price rejector generate trading signals? Well, it looks at 4 things for the most part. Volume traded on the bid and offer, recent price action, market imbalance, and it determines if the market is trending or in a range. Why is that important? Well, I'll talk about each one. Volume traded on the bid and offer. Again, I sort of talked about that earlier. As you're reaching your high or low, you're going to see the volume decrease when you reach, your low or your high. The last buyer has bought, the last seller has sold. You want to see recent price action. Is the market going to be primed for a reversal? You want to see market imbalance. Is, you've been selling off. Now you want to see, if you say you've been selling off, what you want to see is an imbalance, a buying imbalance, showing you that, aggressive buyers are taking over in the market and the price is going to start to move up after a move lower. And, important thing is you want to determine, has the market been trending or has it been trading in a range? If, price rejector is going to key you in on price reversals. So you have to be trending. You have to have a trend to reverse. Otherwise, what are you going to reverse? Nothing. If you're trading in a range or an area of congestion, it's a risky trade. You're not reversing anything. In that case, you're just taking a shot, thinking the market's going to break out. That's not trading a reversal. The price isn't being rejected. When you're trading in a range, you're putting in theoretically, its value. The market is going sideways. It's going, trading horizontally. So it's an area where 2 things: either there's not a lot of volume, say, it's before a Fed announcement or before a big numbers coming out, that there's just no interest for people to trade, or it's an area where it's putting in a lot of volume and it's just trading sideways on you. Everyone's happy to trade. The market is doing what it's supposed to do, is facilitate trade. So it's important that, if you're looking for an area to reverse, you should really have a trend that was going in a direction to end and then start your reversal. You can't reverse something if you're not moving. So what makes the Orderflows Price Rejector different than other indicators? Again, I hate to use the term indicator. Again, it's something that we designed based on the order flow analysis that I use in my trading. It's not. I don't like to think that it's a red light, green light thing. I like to look at an order flows chart and sort of confirm it. But again, if it will work on a normal bar chart where you can't see the order flow, and it does generate good signals by itself. So the problem with normal indicators, price-based indicators, is they leave out what I think is the most important part of market analysis, which is participation or volume, or lack thereof, which will give you insights into price levels that are being rejected. Why is that important? Well, not all prices are the same. And you shouldn't treat all prices the same. If you're trading a price-based indicator, it doesn't take into account volume. So if you trade 1 lot or you trade 1,000 lots, it treats it the same. If you traded 1 lot at 2103, it doesn't care. It sees, oh, it traded at 2103. Well, it's important if it trades 1 lot, if it trades 100 lots, or if it trades 1,000 lots. If you trade 1 lot or you trade 1,000, you'd probably look at it different as opposed to just trading, an average volume number of 100 or 200. So price levels where there's minimal volume or participation shouldn't be looked at as the same as a price level with massive volume. A fair price, think of the market. Markets trade basically two prices, fair price and unfair price. A fair price is a price level where a lot of trades occur. An unfair price is a price level where few trades occur. Why is that important? Well, markets move from fair price levels to unfair price levels and back to fair price levels. That's the purpose of the market, is to find a price level where everyone is happy to trade at. People talk about the noise in the market, market's moving around, oh, that's a lot of noise. Well, that's the market looking for a fair price level. Markets go up, they go down. That's the purpose of the market. It wants to find an equilibrium where most transactions can occur. That's the fair price. Now, trading opportunities occur when the market is trading at an unfair price level because the market exists to seek a fair price level where a majority of trade can be facilitated. So, if prices start getting too high, naturally, in a normal market, the price will go back down to a fair price level. Now, there's going to be instances where the market goes up, and you think it's an unfair price, but then the market keeps going up. Well, it hasn't found its fair price level. The market is searching for a fair price level. Okay, so the first rule of trading, every book, buy low, sell high. Well, the problem is they don't tell you where's the high or the low. It's simple. Everybody knows buy low, sell high in anything, whether it's the real estate market or the futures market or a stock market or, the Pokemon trading card market. The idea is to buy low and sell high, but the problem is you don't know where the high or low is. What you're going to do is you're going to look to the market to tell you where the high or the low is. It's difficult to pick the high. Honestly, it's very difficult to pick a high and a low. The best you can do is pick an area that's around the high or an area around the low. Okay, so I want to show you a variety of different charts and time frames so you get a better sense of how the price rejector looks and works. The price rejector works on normal bar charts, but I think you'll get the best results with an Orderflows Trader's chart. The Orderflows Trader chart is a volume footprint chart, so you can see what's trading at, how the market is trading in terms of volume. Again, if you're not looking at volume and what's being traded, you're really missing out a lot of the market. In the old days when there was the trading floor, volume had, in a sense, two definitions. It had definitions in terms of the amount of contracts traded and volume in the sense of how loud it was. The louder it was on the trading floor, the more trading was happening. And the quieter it was, the less trading that was going on. And sometimes it was very quiet and there was just no trading going on. And in a sense, that's how it is with volume, the number of contracts traded. When you get very little volume traded, there's not much trading going on. So, what's the first charts we'll talk about is the Orderflows Trader 5 range chart. This is the E-mini. Okay, so you have this recent high here. This hash line is going to be the signal telling you, hey, this is the level. Again, you could adjust this. If you don't want to use a hash line, I like the hash because it's sort of telling me, this is going to be my resistance in the market, as well as this zone. Again, you can adjust the colors. I'll go over the settings later, but you can adjust this. If you don't want to have this zone, 5 bars out or 3 bars high, you could adjust all that in the colors that you want it. I prefer red for sell signals and green for buys. Green or blue, I go either one. So again, okay, this is what day is. This is May 17. 5 in the morning, Chicago time. Yeah, I know most people aren't really trading at that time, but there's decent volume. It's late morning European time, so the volume's decent. A lot of arbitrage going on between the S&Ps and Euro stocks and FTSE. So we have a nice little sell-off there. Okay, here coming in just after the cash open, we get a buy. Didn't really work out. Yeah, it did go up before coming back down and stopping out. Again, you should know how to manage your trades. if you're going to have a stop, it should be below this green hash line. It's not something that you should be having a stop, a point away from this low. You can have a fairly decent tight stop. I usually like to use 2 to 3 ticks. I'm not using 4 ticks or a point. And this one it didn't work. Now, if you're reading the order flow, you get a buy signal here, then you've got a ratio here. You had a ratio here, which is encouraging, but then you're getting along in this bar, and you're seeing a ratio here telling you, hey, be careful. And you got a pretty decent selling imbalance here, and the market's starting to come off. Okay, you should really think about, hey, maybe I should, take a small loss, scratch it, or it's not something that you'd necessarily want to, stare this in the face as it starts going lower. Just be careful once you start seeing, that's why I like an order flows chart as a normal bar chart, because an order flows chart will tell you this information. You can see ratio. You can just sense it's coming down to your stop price down here. Okay, and it stops you out. Again, this trade didn't work. Sort of coming back up here. Okay, getting some signs here of some price rejection up here. Depending if you're getting short on this, where you're having your stop, right behind here, or maybe a tick. Like I said, I like to use 2 or 3 ticks, so, even if I had gotten short here and my tick stop was at this bar, yeah, I would have been stopped out when we traded here. I'm getting another signal, okay? The market hasn't found its level yet, okay? So we start, but it's giving you another signal here, so you get short again. And, what happens? Okay, is getting short somewhere around, what is that, 57 again? Earlier, maybe getting short somewhere around 56.5. You're risking, a point and a half, maybe. And, the market starts, what does it do? Okay, this is where we are here. So, you get short somewhere in here around 56.5, 57. We trade down to, where's this down now? Here, down to 52. We're just trading around the 52 level, then boom, you get another buy signal here, and it just rallies literally straight up to another sell signal, and the market, what does it do? It sells off nicely again. So you catch a nice moves down, nice moves up, nice moves back down. Okay, so this is, oh, is this a different? What's the time there? It's 9:22 at that high. Okay, well, this is a little bit later. You get another sell signal here. Yeah, I mean, you get short in here, it sells off, then it starts coming back up. Honestly, that's where you should, talk about trade management. It doesn't stop you out. If you're sticking to your straight stop, right up here, it doesn't stop you out. But, really you should be using some sort of trade management where you could be trailing your stop ideally. So, maybe you're getting out somewhere down here. You're getting a little bit something out of this trade. If not, you're sticking to your straight stop. Me, I prefer to keep it, my stop, the original stop. I don't necessarily trail my stop all the time, but sometimes I do. It really depends on me. If I've been taking if I took a few losses in a row, I might start trailing my stop. It depends. It's a personal choice. And, but it doesn't stop you out, and then it comes right back down. Although you're starting to get up here thinking, your stomach is churning, thinking, oh, I'm going to get stopped out now when I had a nice winner. But still, the market continues. This is the area of price rejection. So even though we come back to it, it's holding. The price is still being rejected. We sell right back down to this area of price rejection at this low. And what happens again? The market it moves back up again. Another, so this is 4 points, 4 points. This is the same day, same trading day. This is a little bit later here. You have this buy signal here. Yeah, the market, you get doji. I'm always concerned when I get doji right after a signal. I like the market to move pretty quick in my direction, but the market, it does, eventually go up. You get, what is 2 or 3 points there before it starts coming back down. I'm always hesitant when, market has been going up, then I start seeing red candles on the way up, even if it's alternating and you got red, green, red. Usually that's not a good sign. You want to see green, 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 not, sort of red, red, red. Just as you see in here, you're seeing green, green, one red, okay, then green, 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 green. You don't want to see sort of alternating. Here you got doji, then red, green, red. It's predominantly red. Okay, so again, it's about managing your trade. If you're getting along somewhere in here, it's giving you a little bit of profit, but once you get up here and you get this candle like this where it's red, and really it's red, start coming back down, you should be looking to take some of it off, if not all of it. Again, don't let it come down and stop you out. I mean, a lot of people think that a trade either has to go right to your profit target or your stop. And why take a full loss on a trade when you could read what's happening in the order flow and take either a scratch, break even, or a small profit or a small loss. Okay, here's one. Sort of again, same thing. You have your signal here. It starts to come off, and it looks promising. You got red candle, but then it turns around here. Again, you got a ratio. But what's important is you got green candle. So if you're short somewhere in here, once you start trading back up, green candle, you sort of poke back up here. Are you going to let it come to your stop? I mean, obviously it's changed. You got a few things. You got ratio. You got a ratio bounce low. Then you got a single print, which indicates on the order flows. It's indicating something to you that hey, that there's some stopping volume down here supporting the market. So even though you're short, you're seeing something like this. You're seeing some stopping volume. The market turns back up and goes back up again. Okay, so what's this? I'll go into the bar charts here. Got a bunch of bar charts. This is a E-mini 1-minute bar chart. This is going back to the first of the month. Alrighty, what time is this? This is May 2nd, Monday. 9:30. You get a sell signal here. It comes off. It's up to you whether you want to get short again, or say you took profit somewhere down here, start coming back up again. You get another short signal here. You got a buy signal. Okay, this was the buy signal from earlier. It goes right back up to another sell signal here, a little bit lower here. This one didn't really pan out. So I think if you're short here, once you start seeing these green candles, you should really be moving your stop down. Don't let it go up and stop you out. A minute chart, any sort of time-based chart is going to be different than a range chart we looked at. Well, I prefer range charts because I like to see how the market moves from price level to price level, rather than, well, the minute is over, it's time to form a new bar, because you're going to get bars that are very small. Sometimes dojis are very small just because there's not a lot of trade, and you get some bars that are very big. Sometimes it's a little bit harder to manage your risk. At the same time, sometimes you get, well, the moves are the same, but sometimes the moves might be a little bit quicker. And then you get a little sell signal in here. Market hasn't really pushed off, and then it moves, boom, it drops right down. Here, you get this buy signal, but you're spending a little bit of time here. Honestly, if I was long based in here, I'd, trading down here, I'd just get out. I'm not expecting it to go back up anytime soon, and it doesn't. You have a buy signal here, and you're spending most of the time below it. There's no reason to still be long. Okay, now you get a market moving. Okay, it's a trendy market. Sometimes, the market is going to stop you out. Boom, stops you out. Here, stops you out. Here, stops you out. These are small losses. Are you willing to take it? Okay, where are we here then? Just one is about 145. Get a buy signal here. Yeah, that's a nice move up. From this, what is that? 71.5 area up to 74. So you get these moves that are taking care of your losses. Here you get a little bit of sell signal, kind of goes sideways. The market's going to give you a chance later to get out at a small profit. I don't think, honestly, once you start getting outside here, it's sort of in the money but not really going anywhere. The market's going to give you a chance to scratch it and either take a small loss or a small profit or a break-even trade. Okay, and what is this? This is the May 3rd. 8:30. You got a couple signals here. Be careful trading around the cash open, just because you're going to get a bit of fluctuation. Even if you took these signals, yeah, it did stop you out. I throw it in there so you can see. I don't want you thinking every signal, this is how it was earlier. I don't want you thinking every signal is going to be a big winner, and then you get the software, you plug it in, you see something like this, and you go, oh, this is the worst software ever. I only watched it for 15 minutes, but I don't need to see any more. Well, I mean, are you really giving it a chance? You could get in a Ferrari, not know how to drive that well, take advantage of a Ferrari. I'm not calling the software a Ferrari, but you get into a fancy car, you don't know all the features, and how to use it. You're going to think, oh, this car sucks, and I say that because there are people out there like that. They throw it up there, they try it for an hour, and if it doesn't work, it's 100% accurate on every single trade. They think it's the worst thing ever. And again, if that's your mentality, then trading is probably not for you. There's no 100% guarantees in the market. Okay, so this was that cash opening time there. This one, it didn't really work out. But here, you get a couple signals bunched together, and boom. Again, this takes care of these couple of small losses here. Here you get a little signal. Yeah, it kind of worked out. Not really. Maybe it. I say it's just sort of hung around. If it's just hanging around for a while. I mean, at what point are you going to say, hey, it's time for me to take a loss? I mean, that's how people. I see it in a lot of people. They don't. I hate to say they don't know how to trade, but they don't know how to trade. When you get in a position, you put a position on, look for the move to happen. Oftentimes people get into a trade and it just goes sideways like this, and they're stuck in it. They fail to see that, hey, the market's going sideways. I better get out, save my bullets. What you want is the move like this, for it to happen cleanly and relatively quickly. You get into a trade here, and then you just get a lot of red candles, sort of alternating back and forth. The trade's not working out, and if you can't see that yourself, then again, you should take some time to watch the market and learn how to trade properly. Okay, now here, this is 11:15. You get a little bit of high signal here, and it's a beautiful one. 52 up to 62. Again, some people, they're trading, oh, here I took a loss, here I took a loss. Oh, this is the worst thing ever. I'm not going to trade it. Oh, and here's a winner. Okay, here, this one, I got long here, but then I got stopped out down here. Well, if you can't see what's happening in here, that the market's going sideways, and you should just try and get out, save your bullets for later. The market's going to give you plenty of opportunities, during the trading day for trades. Again, there will be some losses as the market is looking for its low. Okay, but if you're just going to say, oh, I took a trade and it failed, this is the worst thing since chopped liver, then again, you're not really giving it a chance. So, here's, would you risk, like I said, would you risk something like this here, where you have, you're getting long somewhere here at 55 and, stop down here at 53? Would you risk this for a move like this? Yeah, I mean, I would. Some people, unfortunately, they don't want to risk this. All they want is this every day. 5 times a day. They want exact highs. They want exact lows, and that's not what trading is. Now here's another one. This is later in the day, just before the cash close. Thing about the cash close, you gotta be careful when you trade around the cash close, because there's going to be a lot of volume coming into the market, and after the cash close, oftentimes you're going to not necessarily get big movements. So here's a sell, and then you spike up right on the cash, right after the cash close, a minute or 5 minutes after the cash close, where it spikes right back up through it. Treating the cash close, it probably has more volume than the cash open, because all the index funds are trying to target the cash close. They don't necessarily target the cash open. So you're going to get a lot of volume, and sometimes you're going to get spikes up and spikes down. Okay, so let me get something to drink here. This is the next day. This is a May 4th in the E-mini chart, in the 1 minute chart. This is just after the cash open. Usually people that know me, are in my trading room, know I like to give the cash about 5 minutes to open. Sort of work through its order book, because you have a lot of orders that come into the market to be executed starting at the cash open, because usually people are working something against the cash market, and they'll trade the futures against it to hedge. So again, this is 5 minutes. I'm fairly safe on this one. You get a nice little move lower. 47 down to 43. Now again, I can say, yeah, you got a nice move lower. Look, you'd sell here and buy here. And it's about managing your trade, knowing where you're going to get out. Honestly, 5 points on a minute chart is very good. I know people that trade minute charts and they're happy to get 6 ticks. This is basically 47 down to 42. Okay, we'll call it 42 and a half. I know people that would kill for something, a move like this just once a day. Be very happy with that. Then later, come in, it's about 9:20. You get a buy signal here. Boom, 48. Shoots straight up to 53. It's another 5 points. So say you're short in here, you're trailing your stop. You get out somewhere in here at 44, and you're thinking, it's okay. Yeah, you can't sit there and think you're going to get out at the exact low. You have your signal here. You're getting short somewhere in here, 46, 46 and a half. Really what you want to get is some sort of meat and potatoes. You're not going to get from the top to the bottom. But again, that's what some people expect every indicator in the market to do for them. And that's wrong. So, you got something here, you got something there. Okay, this was that move up, before it starts coming down. Again, you should, don't think every move is going to go to infinity. People have this thinking that every move that they're in is going to go to infinity. And you should be able to read the market and see, okay, hey, you had this spike up and you got red candle, red candle, red candle. Hey, I better get out. If you can't see that developing, you might want to take some time off from trading and just watch the market and see how things develop. Because, the worst thing that's going to happen is you get long here, and you're stuck. You're thinking, hey, this is the move, the monster move for the day, and you just start drifting down, and going lower, 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 and then you get stopped out when you had a nice winner. Okay, here, another buy, another buy, another buy. Fail, fail, fail. Well, this one, you probably could have got something out of it. I think you could have got, at least 2 points out of this move. This one, again, as soon as you buy, if you just see red candles afterwards, you can cut your losses. Here, you got green, green, okay, but then you're staring at doji, doji. Be careful. Here, you're getting along. You got a big up bar, but then you follow it, you got a big down bar. Okay, well, it's probably going to stop you out. Your chances are you're going to get another down bar. If not, be careful. Again, you don't want to see red when you're getting long. You don't want to see down candles after you get long. Ideally, you want to see green candles. Then when you just sort of start going sideways here, doji, doji, it's usually a sign that, hey, you should reassess this and, try and get out with, a small loss or a break even. If you can, if you can get a tick or so out of it, then great. But this one especially, you're buying it in here, and then you got red candle. As soon as you buy it, it's never really in your favor. It sort of comes back up. You got red candle, red candle. Are you going to let it come all the way down here to stop you out? Honestly, if you get red candle, you see it start to go up and then turn around and go red, chances are it's not going to all of a sudden turn around and go up. I mean, how many times have you gotten into a trade down long and the market starts moving against you, 1 candle, 2 candle, 1 bar, 2 bar, and then all of a sudden turn around? You don't want to be waiting for that to happen. Take what the market is telling you and get out. Okay, so what do we got here? This is, you got a short here. We're at 44. It's kind of going sideways, before it sort of pops down lower. Okay. Okay, so this was the first sell signal. It didn't really work out. This one, it's telling you to get short, and then it tells you to get long. So you could have got a little bit of something. Again, you're getting long, then you get another sell signal. So yeah, you're getting a little bit of this, I hate to say chop, but it's taken into account. You get a little bit of something here, is what I'm saying. You're getting short, then you're getting long. So maybe this first trade is a scratch. The second one you probably could have got a point or so. And then this one would stop you out again. You're getting short, and it's just spending all this 2 minutes already as a minute chart. If you're already above above your sort of your area, it's again, this you're only talking about a tick here, maybe 2 ticks where it stops you out. It doesn't catch this move. Sometimes it just doesn't. Ideally, I'd love to have a sell signal here, but it doesn't. This area is. It did give you, I think, net. Well, this one would be, definitely, I think, a loss. This one, I think you got a little bit here, a little bit there. Here is this very small loss, maybe a half a point. Okay, let's go on. Here, this is a little bit later in the day, and you're getting along here. You got doji. Okay, it does pop up, and again, you should learn about price action. If you don't know order flow, then okay, that's fine. You don't need to know order flow, but at least understand that the market's going up. If you're looking for the market to keep going up, and then you get a bar here that doesn't even take out the previous high, it's not a good sign for the market. So you're long, somewhere in this area here. And then you get this bar, this inside bar. Then you even get this one here, where it just, again, you have your whole move basically retraced back down. It's time to cut your loss. Scratch that trade. Don't let it come all the way down here and stop you out. Read what's happening. We all want to be optimistic and think every trade is going to work out, but that's not how it works in the real world. I hate to burst people's bubbles, but that's just the reality of the markets. And again, you can have what you think is the greatest indicator, and it just doesn't. Not every trade is going to work out. Okay, here, this one, no, it stops you out. You get stopped out. This one, okay, well, this one's gonna be, I'll be honest, if I was trailing my stop, it probably would have stopped me out, or, honestly, I probably would have kept it, because, I'm not saying I'd get short on this bar. Honestly, I'm already short off of this bar. It just, it does come up against me by a point, but, it's a minute chart, so sometimes you're gonna get these bars that have wide ranges. That's why I prefer range bars over minute charts. But I still got to trade it around the same way. So even if I got something out here, I could have trailed it, or if not, I still would be short. I'd still be short. So if I'm getting short here, 44, it's coming down to 42. This is already 2 o'clock here. Coming into the last hour of trading, more or less. And if I'm not taking any profits down here, once you start coming back up, and that's why you should watch what's happening. You hit a low, then you got higher lows all the way back up. It's usually not a good sign. So this was that was the first few days in May. Again, I can't show you everything, otherwise this presentation would go on forever. Okay, what I got here? I've got bonds. I'll show you some bond charts here. Bonds are interesting. Bonds are a great market, I think. It's even if you just want to scalp a tick or two. A tick is worth 31 1/4. If you could get a tick here, a tick there, it adds up. But if you could get nice juicy moves, 5, 10 ticks in a move, then hey, it's happy days. Okay, so here we are, coming down. This one, no, it didn't work out. Getting long, and it just moves right lower. It does pop up a bit. You're getting long here. It's a red candle, so it does pop up initially before coming off. Then here you get another buy signal. And, it's a nice move. It's about, I don't know what that is, 8 ticks before coming off. I mean, honestly, I don't remember what the news was on this day. This was earlier this month. And this is a 5-minute chart. This is not the 1-minute chart we're looking at. So you're going to be looking at it a bit differently. Again, 5-minute chart. What's your holding time? At least 5 minutes. I'll say at least 5 minutes. I mean, it could be at least a second. But I mean, are you going to be looking to hold a trade for an hour on a 5-minute chart? I mean, you gotta think. Most people don't think about these things. How long they're going to be in a trade for, and especially if the trade starts going against them. But it's something to keep in mind. So here's something. Here's a trade, and boom. You go lower initially. It doesn't stop you out. Before it starts going up. Again, what's your profit targets? What sort of profit targets? What sort of risk are you using? You have this other lower low here. Not lower low. You have this other signal here. I said lower low. Before you get a nice move up. This is 08 up to almost 28. That's 20 ticks. That's a nice move. Here's a nice little move, 4 or 5 ticks. Honestly, in the bonds, if I could get 5 ticks here, 5 ticks there all day long, at the end of the day, you do that a bunch of times. It's a nice payday, especially on just a one lot. You can make decent money. Okay, now here again, I do want to show you. This is the first one was what, May 2nd, the first day. Here was May 3rd. Fail. Yeah, I say fail, even though it did go lower, but it still stopped you out. Now, it depends what this chart. I have set my bonds and S&Ps. Even though I do look at the overnight markets, I'm showing this chart is what I call Mike's index hours, which is basically 7 in the morning until 4 in the afternoon. This one initially worked out, but then again stops you out here. Get a little bit of a stop out. So you got nothing worked out. Some people plug it in, and this is the first day they're going to get in that market. I said, don't plug it in and start throwing real money at it until you understand, how it works and make sure you understand the signals and what sort of risk you're willing to take. Here, this is towards the end of the day. I do trade bonds until at least 2. And 2 is sort of the old floor, corresponds to the old floor close. You do get moves though. Sometimes you get nice moves after 2 o'clock. But this was you get something here to at least salvage your day. It doesn't really go down and stop you out all the way. Again, I don't know if you would have been willing to take that risk down to this low here, which is that same low from earlier. But if you were, at least you salvaged your day there. So this is the next day, May 4th. What do we got here? Okay, this one, no, it didn't work out just before 9 o'clock. You're getting long here. It just comes right down. 2 bars stop out. And then here you get a nice buy signal here. You're getting long around 164 even. Where does it go? It goes up to at least 12. Honestly, when you get up to this area, realistically, I probably would have been getting out in here. I said I'm the type of guy. I'm happy to get 5, 6 ticks regularly. This one, no, I don't know. If you're trading for 4 ticks, 5 ticks, okay, maybe. But then, if you manage your trade, you should have your stop just up here to stop you out. But I don't know if I would have been taking this trade here. Look at the time; it's already 2:30. I do like to take trades, before 2, but once you start getting after 2, I like to see trends happen before the close, before the old floor close like this, rather than sort of have the cash session theoretically close, 2 o'clock. This is, what a lot of people consider the close of the cash market for bonds, rather than look for the move to happen here. But I mean, it's up to you. I just put it there so you can see how it looked. Okay, here's a couple trades. This one again, it's sort of before 7:30. Again, I don't know if there was some number that came out on this day. It's May 9th, I think, was Monday after payrolls. You got quite a bit of fluctuation here, so you could at least probably gotten your 5 points, 5 ticks. Here you could have got your 5 ticks. Here, yeah, okay, I'll call it a stop out. Here, a stop out. Here, okay, maybe it stopped you out. Now, I probably shouldn't show that day, but I want to show you guys these things. This is the 10th of this day here. I had to turn my machine off early that day because I had something on, but these are the days you love. That's why if you can trade every day, that's great. Because the last thing you want to do is miss a day like this. You get your buy signal. When you get them bunched together, I like it when you get them bunched together like this, one right after the other, and you get a nice move straight up to a sell signal, a nice move straight down, another sell signal down, then another buy signal up. this is the next day here, the 11th. The 11th, unfortunately, there was no trades that day. Was this May 12th? Okay, this is a Thursday, because I remember it was Friday the 13th coming up. Okay, you get a buy signal here. Well, the low, it didn't find its low yet. And then it hits its low here. Unfortunately, there was no signal there. So you take a little bit of loss, but then here you get a nice buy signal. And it starts to go up and then kind of stalls out. Manage your trade here. This one, yeah, kind of goes nowhere on you. So even if it doesn't stop you out here, the fact that it's just going nowhere, it should be a sign to you that it's probably going to stop you out. And where are we? Friday the 13th. Okay, get a sell signal here. Comes right back up. Keeps testing this area here, the top of this bar, where it's noticing the price rejection. And then it sells off. And then it goes back up. But again, you should have your profit targets in mind. Don't expect it to get one signal early in the day and you're going to ride it all the way to the close. No, the market's going to rotate back and forth all day. Here you get 11-ish, you get a 11:15, you get a sell signal. It doesn't work out. Again, have a tight stop, you're out. You've made a decent profit already earlier in the day. So, as you can see, the price rejector works on a variety of different markets and time frames and chart types. Not every signal generated will be a winning trade. There's no 100% right trading system or method. What you should be concentrating on is areas where prices are being rejected, which can lead to low risk entries that have good reward. And when it fails quickly and is easy to see so that you can manage your risk. And managing your risk is essential to being a good trader. If you can't manage your risk, you'll never be a good trader. There's just no way around it. That's why if you read any sort of biography, if search the internet for the history of Brevin Howard or Tudor, it's all about risk management, controlling the risk. And yeah, it's you got to pick good trades, but you can pick mediocre trades, and as long as you manage your risk, you'll still do okay. In the long run, the thing is, you want to last, you want to survive. You want to be around to play tomorrow. And if you're not managing your risk, then you're gonna have a problem. I knew a guy, the way he would trade his account is he'd take whatever money was in his account, which is basically his net worth, and divide it by 4, and that would be his margin for the trade. So say he's got 20,000 in there. Okay, he could 5,000. He'll trade 10 minis like that. It's not necessarily the greatest form of risk management. So, earlier I said trading opportunities when the market is trading at unfair price level, as it will often seek to go back to trading opportunities exist when the market is trading at an unfair price level, as it will often seek to go back to a price level. So I'm going to change that. In case people reading this get confused. However, that doesn't necessarily mean that the market will reverse back up or down. If the market is trending, it may still be looking for a fair price in that direction. So what do I mean? Let me explain further. So when the market comes into an area of price rejection and doesn't reverse and instead continues in that direction, is often a sign of a stronger move by longer term time frame traders. Okay? Nobody wants to willingly trade at an unfair price, although people do. It's because the current price may seem unfair now. Say the long-term trader views it as a stop on the way to the next fair price level. So like what I mean when I say people don't want to trade at an unfair price, although people do. If you're a long-term trader and you're looking to hold a position for weeks, months, you're not trading on a day time frame. You're trading on a longer-term time frame. So what may look as expensive to a day time frame trader will actually look cheap to a long-term time frame trader. Ugh, that's a mouthful. So that said, I'm going to show you a few losers here. Again, it's about managing your risk. So we're coming up. This is a 1-minute chart. It's not the greatest chart to show you something on, saying that there's long-term time frame. When you're trading on a minute chart, you're really not looking at long-term time frames. If you're looking at sort of a longer-term chart, 15 minutes, okay. But 1 minute, don't start thinking long-term. So you're going up, okay. It hasn't found its level yet. It's kind of thinking maybe we found it here, so it goes sideways. This is kind of a market going sideways. It doesn't really go higher, does, but then it comes back off, sort of retraces it. Sort of still looking for its fair price, so to speak, to satisfy the long-term traders. Long-term traders are in control until the market finds an unfair price level to reject. Here, it's moved down. It hasn't really found its level yet. So if you're buying here, you get stopped out. Again, you should manage your trades before it finds its low level here, and then starts moving back up. Has it found its resistance on its way back up? No, it hasn't. It blows right through this level before it finds its resistance level and starts to sell back off. That's why that's why I say I love this indicator. But I mean, that's the way I designed it, and I mean, this is a way we trade with order flow, myself and a few of the people that I know. And it's about having tight stops. I mean, and it's telling you it's market generated information. What you're seeing is generated by the market. It's not drawing lines, sitting up late at night in the dark drawing lines, and hoping the price gets rejected here. Because to be honest, if you're drawing a line here at 2042 and you think, oh, I've got the level, it's a secret, my own Mike's secret level. Well, if I'm the only one that knows about it, who's going to make the market reject that price? The market is a mixture of a lot of different people in the market, long-term traders, short-term traders, and everyone in between, hedgers and everything, arbitragers. So, if nobody else is looking at your level, chances are it's really not going to be very effective. I hate to burst people's bubbles in that sense, but that's the reality of it. Okay, so here I want to show you, this is an E-mini 30-minute chart. And, the point that I want to make is it can work with longer-term charts, longer duration charts. It's a 30-minute chart. And the point that I'm trying to make here is, are you willing to accept a small risk on a trade for a potential large risk? So here, you got a sell signal. Okay, market sells off. Just for simple purposes. I'm not saying you manage the trade, you'd get short here at 65. I'm just using this as an example. Ideally, you should wait till the bar closes, get short in the next bar when it opens. If you struggle to do that, there's actually add-ons you could get to NinjaTrader that when it looks like it's setting up, as soon as the bar closes, you could actually set it up so that it will shoot your order in as soon as the bar closes, so you're getting short, on the first print. But, realistically, there's plenty of opportunity to get short at 65 because it opens up, trades down. So you got plenty of chance. And your stop, again, is just going to be, behind this, the hash mark. So you have your stop up here at 67. Okay. Market, you get short, does sort of come back up and then sells off. 65, it comes down to 60. It's a 30-minute chart. Hey, that's 5 quick points. Do you want to take it or not? I mean, I don't know. It's a 30-minute chart. Maybe you got a bit, maybe you're a swing trader and, you want to take, let it stew and simmer a bit. Okay, so, but are you willing to risk this? 2 ticks. Okay, you get short, stops you out an hour later. You're willing to take that loss for a trade like this? Here, you get short. You're talking 64. Later that day, trades all the way down to the next day, even 44, 20 points. Are you willing to take a 2-tick loss in anticipation of a move like this? You could take 10 of these losses. You only need 1 win like this. Would you take 10 of these losses to get 1 move like this? There's going to be moves where you get half of this. You get part of this. Even this one initially moved 5 points in your favor before turning around. Again, I don't remember what happened on this day. This was on May 2nd. This is on May 17th. But if you could catch days like this, again, if you're a swing trader, these are the days that you salivate for. So, just real quick, the price rejector, it runs on the NinjaTrader trading platform, and it works on an Orderflows Trader chart as well as normal bar charts. Personally, I think to get the most out of it, you should use Orderflows Trader's charts. I think you should be reading the market and seeing what's happening in the market, but not everybody uses Orderflow, and that's why we designed it for normal bar charts. And it'll work on just about every futures market and time frame, although there's going to be somebody that's going to say, well, it doesn't work on the mid 30 on a 1 minute chart. Okay, I'll give you that. It doesn't, I'm not going to say it works on every single chart and is profitable on every single time frame. It's a tool, right? You have to know how to trade. You can't build a house with a set of tools if you don't know how to use the tools. Again, there are people that come to me, they think that whatever, the Orderflows software and the price rejector or the Delta scalper is the holy grail. It's not. You have to know how to use it. Again, what's the purpose? People go out and they buy fancy cars, but if they don't know how, they just want to look good. They're not really getting the most out of it. And, it's kind of a waste. I mean, yeah, it's great if you want to pick up chicks. If you got a Ferrari, then yeah, you'll get all the women you can handle. But, if you're a true driver, and you want to, get the most out of your car, you're gonna say, hey, Ferrari, I want to go to your driving school and open this car up on the racetrack and really understand, feel the power and the majesty of this car. So pricing is going to be up on the website, but if you're an existing Orderflows Trader software user, send me an email. I'll give you a deal. I haven't got the link up yet, but it'll be going up soon. I'll be sending out an email to all the users. It's basically, at cost. I mean, unfortunately, there's costs involved. Now, I'm not a programmer myself, so I got to hire somebody. But, it's, again, I'm not trying to charge thousands and thousands of dollars as some people do. Somebody will get an indicator, and some people like to charge thousands of dollars because people will pay for it. That's not what I'm about. I try to keep things low cost. People have told me I should charge more, but that's for what? Orderflows is out there. It's just understanding it. That's what I'm here for, is to help you understand Orderflows. My tools aren't expensive, and by any means. But there's time involved and costs involved, and I tried to keep things low for everybody to take advantage of them. So thank you for watching this this video, webinar, whatever. It's if you got any questions, send me an email. My email is mike@orderflows.com, or go to my website, my main website, www.orderflows.com, or visit the Price Rejector website. Well, actually, this video is going to be on there, so you'll just be watching this video again. But, you send me an email. They say you got any questions, go to orderflows.com and send me an email, and, I'll do my best to answer it. And, if you're interested in this indicator, shoot me an email. Again, it's mike@orderflows.com. If you're an existing user, let me know. It's something that I think can benefit a lot of people, especially swing traders. So, thanks, and see you on the other side.